Have you ever noticed that the biggest global crisis never start where people expect? Everyone thinks the next financial meltdown will come from the US debt, or China's housing market, or maybe even the crypto space. But right now, a completely different country is flashing red. A country most people assume is stable. A country with one of the strongest reputations in the world. Japan. Today, I'm going to break down something almost no one on YouTube is talking about. Japan's bond crisis, why their economy is suddenly wobbling, how this links to escalating tensions with China, and how the fallout could hit global markets, including crypto, far harder than people realise. Welcome back to the channel, I'm Paula, and here we break down global markets in a way normal people can actually understand. No hype, no fear-mongering, just the truth about what's really moving the markets and how it affects you as a trader. And today's story is a big one, so let's get into it. For decades, Japan was known for two things: ultra low interest rates and the world's most stable bond market. The Bank of Japan kept borrowing costs at rock bottom levels for almost 30 years because inflation barely existed. So investors could buy government bonds or JGBs without worrying about price swings. And because Japan is a wealthy, export-driven nation, people trusted it. But over the last year, something has snapped. Japanese bond yields have surged to levels not seen since the early 2000s. The 10-year bond, which acts like a financial heartbeat, has climbed towards 1.8%. Longer term, 20 or 30-year bonds have sold off even harder. Now that might not sound like a big number, especially if you're used to the US or UK, but in Japan that's a shockwave because the entire financial system, banks, pensions, insurers, government budgets, was built on the assumption that yields would stay close to zero forever. Imagine building a skyscraper on sand, assuming the sand will never move. Suddenly the ground shifts. That's what's happening in Japan. There's three major reasons why Japan's bond market is cracking. First, inflation has returned for the first time in decades. Japan used to fight deflation. Now it's dealing with the opposite problem: rising prices, expensive energy, a weaker yen making imports costly, and supply chain bottlenecks. Second, the Japanese government is rolling out new stimulus packages, over 20 trillion yen worth, which means they need to issue even more debt. More debt means more bonds. More bonds means markets demand higher yields. It becomes a feedback loop Japan can't easily escape. Third, and this is the biggest one, the Bank of Japan is slowly losing control. For years, the BOJ printed money, bought bonds, and controlled yields. They were basically propping up the entire market with unlimited intervention, but now markets are testing them. Investors want higher yields to compensate for inflation and risk. The BOJ wants lower yields to keep government borrowing affordable. Something has to give. And what we're seeing today is Japan's grip beginning to slip. Japan's debt to GDP ratio is the highest of any developed country, over 250%. That means the government must roll over massive amounts of debt every year. If yields rise too high, the cost of servicing that debt explodes. And here's the part that people never really think about. If Japan suddenly needs to pay much higher interest on its debt, the entire national budget gets eaten alive. Money that should go into schools, infrastructure, social services, and innovation goes straight into interest payments. Japan becomes trapped. Meanwhile, Japanese banks, insurance companies, and pension funds hold trillions of yen in government bonds. If bond prices fall, those institutions take losses. Some could even face liquidity problems. This is how a bond crisis becomes a financial crisis. So let's think how this spills over into the global economy. Japan isn't some isolated island. It's the world's third largest economy. It's a huge exporter. It's the backbone of global manufacturing and supply chains. And its financial institutions are some of the biggest international lenders. If Japan's bonds melt down, here's what happens globally. US Treasury yields rise because Japanese institutions sell foreign assets to stabilise at home. European yields rise for the same reason. Emerging markets suffer outflows as investors flee to safety, currencies wobble, funding markets tighten, and risk asset falls. This is exactly the kind of slow burn event that can tip the global economy into recession without anyone realising the spark came from Tokyo. But now let's add China to the mix. That's where things get explosive. Japan and China are currently experiencing their worst diplomatic crisis in years. This all escalated when Japan's new Prime Minister made comments suggesting Japan could intervene militarily if China attacked Taiwan. China responded with economic retaliation, banning Japanese seafood exports, cancelling cultural events, freezing certain exchanges, and issuing strong warnings. This is not minor tension. This is a geopolitical reset. So how does this tie into Japan's bond crisis? In several ways. As tensions rise, Japan feels pressure to increase defence spending. More defence spending equals more borrowing equals more bonds issued. More bonds issued, more pressure on yields. At the same time, China is Japan's largest trading partner. If China decides to reduce tourism, cut imports, or slow trade flows, Japan's economy weakens. A weaker economy means lower tax revenue and higher deficits. Higher deficits means issuing even more debt. Now combine that with rising global rates and a weakening yen, and you have the perfect storm. If China pushes Japan economically while Japan is already vulnerable financially, the bond crisis accelerates dramatically. And that's not even the scariest part. What really worries financial analysts is the Taiwan angle. If conflict or military tension breaks out near Taiwan, it will shock global markets in a way we haven't seen since the 2008 financial crisis. Semiconductors, shipping routes, technology supply chains, energy flows, everything is affected. And if risk assets crash, it feeds back into the Japanese bond market as investors panic. This is a two-way crisis. Financial stress makes geopolitical tension riskier. Geopolitical tension increases financial stress. Japan and China are now wrapped tightly together in a way that could spiral. And all of this affects crypto. Crypto doesn't sit outside of global finance. It reacts instantly to risk sentiment. If Japan's bond market deteriorates further, here's what could happen. The yen weakens and Asian investors pull back from risky assets. Crypto volumes in Japan and Korea drop. Bitcoin volatility spikes during Asian trading hours. Altcoins get crushed. Liquidity dries up across exchanges. Now add the China-Japan geopolitical layer. Anything involving Taiwan instantly hits crypto first. Traders understand that semiconductor supply chains, global tech, shipping routes, and risk sentiment all collapse at once. Bitcoin drops, ETH drops, everything except stablecoins goes red. And during a liquidity crisis, liquidations cascade faster than in stock markets. This is exactly why the crypto market reacts violently during Asian macro events, even if Western audiences don't immediately understand the connection. But here's the interesting part. Extreme fear often creates the best long-term buying opportunities. Whenever panic reaches its peak, smart money quietly accumulates while retail panics. And that's why staying informed matters. So what are we looking out for next? The world is watching Japan extremely closely right now. If yields keep rising, if the BOJ loses control, if China escalates economically or militarily, if global investors start dumping risk assets, this could be the catalyst for a major global downturn. Not a crash tomorrow, not a collapse next week, but a slow grinding financial crisis that starts in the one place no one expected it, the Japanese bond market. Most people won't see it coming, but now you do. The world is shifting fast. Japan's bond crisis, China's tensions, recession signals, crypto volatility. These aren't isolated events, they're connected. And over the next year, these connections are going to matter more than ever. So if you want to stay ahead of the market and learn the exact strategies we use in the Crypto Wolfpack to make money in both the bull market and the bear market, we've put together a completely free course for you. It explains everything step by step and it's linked right below in the description. Let me know in the comments, do you think Japan's bond crisis could be the trigger for the next global recession? Or is this just another overblown headline? Thank you so much for watching and I'll see you in the next one.